Hello. In this video, we'll consider depreciation and amortization deductions. Now, you might recall that in previous discussions, we talked about the distinction between capital expenditures and immediate expensing. Recall that with immediate expensing, the taxpayer could deduct the item immediately and not have to wait until the future to get the benefit of the items with respect to basis. The idea of a basis is, think of it like a storage of pre-tax capital. The idea is that in our system, we have to define what income is, and when defining income economically, economists, politicians, academics, practitioners have, again, created this idea, and through the law, whether it's through Congress, whether it's the IRS, whether through academic publications, whether through the judicial system, that income has been derived a certain way, and our whole income tax is based on that income system. And taking that into account, this idea of basis has come along for the ride, if you will. The best way to think of basis is think of property that you purchase at one time and you sell that property later on, or you exchange it later on. You shouldn't be taxed on the property that you, at least the value you initially brought into this storage pot, this imaginary storage pot of capital. The idea is that you probably acquired that property through some way that you were taxed, whether it's working at a job and you were taxed on that income, or you got income by selling your other investment stocks, property, and that was taxed some way. I mean, obviously, it's possible you can inherit money or something, but most likely you got that money through some other tax way. So that's really what this is about, is keeping in mind that we don't want to really keep taxing pre-tax capital, if you will. And we'll talk more about basis in later discussions. So any capitalized cost creates or adds to basis. So if you have a capital expenditure, it's going to go into the basis of the property. And that storehouse of unrecovered capital will potentially be able to be deducted through depreciation or amortization, which is this topic. Depreciation deals with tangible property. Amortization, though, deals with intangible property. Now, if you don't get the benefit of depreciation or amortization, there may be other types of deductions, but if you can't get even those deductions, just keep in mind that the unrecovered, the storehouse of capital that's in your basis still stays the same. So when you sell it or exchange it, you get to take into account that amount. Again, we're going to talk in the future, other discussions, about how exactly to calculate basis. But that's not what we're talking about here. In this discussion, you will know what your basis is. It's just how do you apply the rules for depreciation and amortization. Now, before we go into those rules and whether depreciation qualifies and the mechanics for depreciation as well as amortization, I want to talk about time value of money. Because time value of money is a huge concept not only in the financial sector in accounting, but also in tax. The idea of time value of money is that a dollar is worth more today than a dollar in the future. That concept applies equally in tax. The idea is that a dollar of reduction in taxes today is better than a dollar in reduction of taxes tomorrow, because you can use that dollar in reduction of taxes today and you can invest it, or you can do something with that money that you couldn't do tomorrow or in the future. It's that whole time, that concept that you have the ability to use that money and the time that you get interest, get some type of earnings off it. That's time value of money. Now, obviously, I'm assuming that the rates haven't changed and other considerations haven't changed. We're just saying that if you could get the same dollar on tax return, or an actual dollar back from the government today, and the same dollar tomorrow or in the future, you'd rather have the dollar today. Now, the main two ways to recover the previously unstored capital, the basis, through depreciation and amortization of assets. These are huge. These are huge issues in tax. If you're dealing with businesses, you're going to have to deal with depreciation and amortization in some way. So first, let's talk about depreciation. Because depreciation, again, as I mentioned, depreciation, we're talking about tangible property. So what do I mean by tangible property? So tangible property is anything that you can actually touch. Anything you can actually touch, feel, see, all the senses of smell, right, that you see. I mean, the five senses, some people say there's a sixth sense. Maybe you can see dead people, right? We're just talking about the normal five senses, right? That's tangible, right? You can see, smell, touch, taste. No one's going to taste, property. But you get the idea. Depreciation is on tangible property. However, amortization is on intangible property. So amortization is on intangible property, and intangible property is property that you can't see, you can't feel it, you can't touch it. That's the key. Now maybe you have stock in a company, right? You have stock in a corporation, and you have a certificate, and you can feel a certificate, the paper, but that's not actually the property. So just keep that in mind that, you might be able to see something that provides, like a contract. A contract is not the piece of paper it's on. It's actually the rights that are protected under the law that allow you to do something. That's what a contract is. It's the whole idea of the rights, which are intangible. So just keep that in mind when you're thinking about the discussion. Now, another thing I want to talk about before we go into the specifics of depreciation and amortization is the distinction between real versus personal property. So real property is land and anything attached to the land. Land and anything attached to the land. That's what it is. So this actually can get quite interesting because if you think about land and the building attached to a land, right, and maybe structures that are on that, that's all real property. We can see that. We can understand that. But let's say you have some land, right, at your university, and you have a building that's attached to the land, so that's obviously real property. And in the building, you have classrooms, right? The classrooms are all real property because they're in the building, right? They're part of the building. In the classroom, you have whiteboards that are actually part of the walls that cannot be removed. Well, those whiteboards, if they can't be removed, if they cannot be easily removed, they are considered real property. So there's all these cost seg studies that, for those of you that are listening that might actually go into tax, cost seg studies deal with classifying items as real property versus personal property, because what you're going to see is personal property generally is going to be depreciable or amortizable much faster than real property is, based on the recovery period. So you can hire accounting firms or various companies that do this as their actual bread and butter practice. They go in and they look at various assets in a company and they say, hey, you have these assets that you're classifying as real property, but we can argue that these are actually personal property and you should be depreciating those much faster. And again, the time value of money concept, $1 today that you can get back is better than $1 tomorrow. Because if you think about it, if you can recover depreciation in 5 years or 7 years, you rather pick 5 years. Okay, for right now, just think straight line, easy. The same amount for 5 years. Okay, instead of the same amount over 7 years. Well, you rather pick the 5 years because you're going to get more deductions early on than you will later on, right? Obviously, the 5 years, you're getting it over 5 years. The 7 years, though, you're going to get some in year 6 and year 7, okay, under a general financial understanding. Okay, you're going to see that when we talk about the depreciation for tax later on, it's not that simple, but the same principle applies. You rather get more depreciation early on, generally speaking, because you can take advantage of the fact that $1 reduction in taxes today is better than $1 reduction in taxes tomorrow. And that applies with any concept when it comes to deductions, where you're going to get the same amount of deductions over time. Over time is the key. So that's real property. Real property is the land and everything attached to the land. So think land, buildings, those are really the key types of real property. Okay? Personal property is everything other than real property. Now I want to clarify that personal property is distinct and different from personal activity property. So remember that in previous discussion we talked about the big three in terms of activities. There's business activities, there's investment activities, and there's personal activities. And any type of deduction or income you're talking about has those characteristics. It has to be one of those. Business, investment, or personal, in that order, right? Well, personal property is just a classification. This is a classification of the legal definition of property. That's all we're talking about here. We're not talking about any activities. So you can have personal legal definition property that is personal in nature. You can have personal legal definition property that is business in nature or investment in nature. Personal property is everything other than real property. So personal property actually can be broken into tangible and intangible property. Because personal property includes everything other than real property. Real property can only be tangible. There's no intangible real property. Just keep that in mind. But personal property can be broken into tangible and intangible property. All right. So let's go into depreciation. So we're going to talk about amortization later on. That's the last topic we're going to discuss. But let's first talk about depreciation. So this checklist is going to help you determine whether the taxpayer can depreciate the basis of a tangible asset. So the first question to ask is the property, that's tangible property, right? Because we're looking at here at depreciations for tangible property. Is it subject to wear and tear? Wear and tear. If it is, we're going to continue. If not, then you can't depreciate. You can't depreciate. Now, I want you to take note that wear and tear is a specific definition in the tax law. So down here, wear and tear is actually a definition that's been through case law, through regulations, and a taxpayer does not need to prove the estimated useful life of a tangible asset in order to claim depreciation. So they don't actually have to show that, hey, look, this asset will depreciate over 7 years economically. No, that's not what we're doing here. By the way, I want you to keep separate economic depreciation and tax depreciation. Tax depreciation, like accounting depreciation, which you're going to see are calculated differently, tax and accounting depreciation, are very similar in the sense that it's a reasonable estimate and understands that property is not going to be the same as it once was purchased. Certain property, right? Now, we're not talking about appreciable property like paintings that might go up in value over time or certain, collectible items. We're talking about items like that either what they possess wear and tear or obsolescence. So technology, right? That over time becomes obsolete. So wear and tear, it's sufficient that the asset's subject to wear and tear, given the taxpayer's use of the asset, whatever the taxpayer is doing, and you need not specify a useful life. Now, there's not even a requirement that the value of the asset decline over time. That's key. This all came from a really pivotal case on wear and tear called Simon versus the Commissioner of Internal Revenue, which I've noted here. And in this case, the taxpayer actually had they were a musician, taxpayer is a musician, and the taxpayer actually owned a very rare type of violin. And the issue was over the actual feather of the violin, the item. I don't even know if that's called a feather. The item that the violin is played with, that's actually what was at issue, whether it could be depreciated. And this specific item that the violin was played with, you see them strumming the violin, right? That item was argued by the Internal Revenue Service that it could not be depreciated because the value did not decline. It was actually a rare item. So this musician was playing with this, old, many hundreds of years old, this strumming instrument on the violin, and the court said, as long as the taxpayer can show us that it actually is, has some wear and tear in some way, we'll do that. And that's what the taxpayer did. The taxpayer basically showed that after every performance, the violin, it sounded just a little bit different. Now, whether it was, it still didn't, it was a, huge difference was one thing. But the idea is that there was wear and tear in the sense that, look, after every performance, the taxpayer, they could distinguish that it sounded just a little different. And that was enough to be wear and tear. That's a very broad concept, wear and tear. So let's continue going down the list. Now, note that after every one of these conditions where the property is not eligible for depreciation, remember that the taxpayer can still get the benefit of the basis when the item is sold or exchanged or some other possible way. So just keep that in mind for all of these. The idea is that we're dealing with timing. We're not saying, okay, depreciation and amortization provides some tax benefit that you wouldn't necessarily get, but for this. It's saying it's just timing. You get the benefit today rather than in the future when you sell or exchange the item. So the next requirement is that the asset be used for business or investment. So remember, there's the big three. We have business, investment, and personal. It has to be business or investment property. It cannot be personal property to be depreciated. Now, it can be held for both. It can be held for both business and personal use, or investment or personal use. And if that's the case, then the taxpayer can only depreciate the portion that's considered investment or business, if that's the case. And I have an example here. What if, a taxpayer owns a truck that is used 70% of the time in the taxpayer's business and 30% of the time in personal use? Well, the taxpayer can only deduct, with respect to depreciation, 70% of the normal amount allowed for depreciation. That's the idea. So if it's business or investment, even if it's mixed, we continue. If not, you cannot depreciate the item. Now let's talk about mechanics, understanding how exactly we go about and we depreciate. Because depreciation for financial accounting purposes, for economic purposes, is different with respect to calculation. So this is what we're going to do. We're going to determine how do we calculate depreciation. So there's really four things we're going to have to consider. We're going to consider the depreciation base. We're going to consider the depreciation method. We're going to consider the recovery period and the convention. And all four of those are crucial to understanding how exactly you go about depreciating an asset. You need to understand all four of those items. So the first is the depreciation base. So you can go through as a checklist and go off each of these. So the taxpayer is entitled to depreciate his or her entire cost in the asset. There's no reduction for the asset's salvage value. So in financial accounting, for example, we actually subtract away salvage value with respect to certain calculations of depreciation. We don't do that for tax purposes. Now, before applying the general depreciation rules, there are two rules that we need to consider with respect to possibilities of getting an early basis recovery, if you will. So those rules, and in order, first is Section 179. You have to know this section number. It's called Section 179, election to accelerate your deductions, basically, is the idea. The election under Section 179. The second is bonus depreciation. And third is the general depreciation. So if you qualify for depreciation under our first checklist, you then have to go here for the mechanics, and it's possible you can get all three of these. It's possible you don't get number 1, number 2, and you only get number 3. Now, in the first year, you can get all three of these. In the second year, you can't get number 1 and number 2. You can only get number 3, just so you know. Number 1 and number 2, Section 179 and bonus depreciation only apply if you meet the requirements we'll talk about in a moment in the first year. These only apply with respect to year one of the asset. So let's talk about first Section 179 election. So Section 179 election is basically the idea here, the history, which without getting too much into it, you're going to see that Section 179 is really for small businesses. There's one theme in the Internal Revenue Code, in the tax law, is benefits for small businesses. That's something that regardless which side of the aisle you are on politically, that has been in favor for both, both sides have been in favor on small business tax incentives or provide tax benefits. So Section 179, a taxpayer can elect to treat the cost of any Section 179 property, which we'll define in a moment, as an expense and not a capital expenditure, meaning that it can be elected. It has to be elected. So you have to actually file an election on your tax return when you have this issue. You can't just assume it happens, okay? You have to make the election. And it's an election to expense, again, in the first year. This is in year one. Okay, and you can take that election, but it will reduce the amounts that you can take with respect to bonus depreciation, if that's applicable, as well as general depreciation. So it reduces that. So after each of these three things, your basis is reduced by these things, for whatever you take. So IRC Section 179, so the Internal Revenue Code Section 179 property is any depreciable tangible property, so it has to be tangible. That's one thing to note. And it has to be personal as well. So it can't be intangible and it can't be real property. So it can't be buildings or other items of depreciable real property. Acquired by purchase for use in active conduct of the taxpayer's business. So it has to also be business. Can't be investment. Now note that this property can be new or used. So the perfect example is, let's say you own a moving truck business and you buy some trucks. You buy one truck that's new and one truck that's used. Well, under this provision, you can take, if you meet the specific requirements, you can take the Section 179 with respect to both of these items because you're allowed to do new or used trucks or assets. Now, this election must be made in the year of purchase. You can't do it later on. So in the year of purchase. So in year one of the asset, which is what I specified. Now, there's various limits that you need to consider, and you need to go into the Internal Revenue Code, your textbook, whatever you're looking at with respect to this topic and how you're learning this topic. And you need to see what the limits are because they change. 1 year, the limit you could take is $500,000. 1 year was only $200,000. 1 year was $25,000. It really depends on the climate. If we're more in a recession, then Congress tries to encourage more spending, and that will stimulate the economy. So we actually try to get more with respect to this item. Now, there's a limit with respect to the amount a taxpayer can elect to expense with regard to this amount. So the limit is with respect to the amount that the taxpayer can elect to expense. And there's also a limit with respect to a dollar-for-dollar limitation on the total 179 property. So how much property you place in service. If you place too much in service, you place millions of dollars in service, then you're not going to be able to take this. So again, this is meant for small businesses. This is meant for small businesses. So if you're a large business, you know, you're the large businesses out there, then like Walmart, right, and you're buying this, then you can't take this election because if you have, you know, multiple millions of dollars, many millions of dollars of assets you're purchasing, then it's going to dollar for dollar reduce this. There's also a taxable income limit as well. And again, this gets at small businesses. So all the limitations are based on small businesses. So please take a look at these limitations. So the next type of special way you can recover before the normal depreciation is through bonus depreciation. And bonus depreciation is a similar concept without all these special limitations. And this is also something that changes year to year. 1 year it was 100%. 1 year it was 0%. 1 year was 50%. There's different amounts in different years. Again, Congress is trying to stimulate. Now, some key distinctions between Section 179 and Section and bonus depreciation under 168K is that, okay, so similarities, they both apply to tangible personal property that is used in business. So they have to have business, right? Has to be made in the year of the purchase, so the first year. So this is, again, year one. Now, this one is not necessarily for small businesses. This does not have to be for not necessarily small business. It can be large businesses too. Again, it depends on the year because the amounts. So not necessarily small business. I want you to keep in mind. So the limitations aren't near as strict as Section 179. Now, one thing is that this property must be new and not used. So if you are buying that moving truck in my previous example, then it's really important to pay attention that, you know, you can get it for the new moving truck, but you can't get it for the used moving truck. So you might actually want to, if, you know, this is something that incentivizes your transaction, taking the benefit of early recovery of through bonus depreciation, you might want to buy the truck new. This is something to consider. Okay, and again, double check your textbook or the Internal Revenue Code, however you're learning this, treatise, whatever it is, with respect to the limitations in your year. Now, again, as I mentioned, any amounts under Section 179 and bonus depreciation, and these are both elections. You have to elect. These have to be, both have to be elected. These decrease the cost recovery basis down in the first year by the amount taken. So just as a simple example, let's say you have property, right? Let's say you have, I don't know, $1 million of property, $1 million of property that's in your business, and it's personal, tangible property, and let's say it's all new property, and it all qualifies for Section 179 and bonus depreciation, but you don't get the full amount. Let's say that based on the year, let's say you can take $100,000 of Section 179, you do that first, and then you take another, let's say $500,000, because let's say it's 50%, it's 50% limit bonus depreciation amount. So if we subtract that away, it's a $1 million minus the sum of $600,000, there's $400,000 left. So we went through number 1, 179. We went through number 2, bonus depreciation, that's 168K. You don't need to know, well, you might need to know that, depending on, your course or whatnot, you might need to know 168K. So you have $400,000 left to apply the general depreciation rules, which this $400,000 is going to be depreciated over time based on the tax rules that we're about to talk about. Okay? And that's where we come to the depreciation method. So everything after this, the next step is to calculate the amount of normal depreciation that's allowed, the general depreciation. So everything after this discussion is now going into the normal depreciation methods, because the Section 179 and the bonus depreciation, those are just, you can take those amounts, whatever the amounts are. There's no specific rules with respect to method, recovery period, or election. It's all that year, and it's all, you just take that amount that you're allowed under the code. So the first thing we need to talk about with respect to normal depreciation is the depreciation method, the method of depreciation. So possible methods include straight line, and double declining balance, and 150% declining balance. These are some of the methods. There's other ones in the Internal Revenue Code, just so you know. But these double declining balance and 150% declining balance are generally speaking under makers. It's possible to get straight line under makers as well, depending on your life, just so you know, and whether you can make an election or not. Okay? And I'll mention that later on. But the key is that with respect to method, it's generally going to be straight line, or it's going to be double declining balance or 150% declining balance. And most property with respect to over here is going to be double declining balance, which is 200% declining balance. All right. Now, in distinguishing the depreciation method, it's important to understand personal property versus real property. Remember, personal property is, the best way to define personal property is it's everything other than real property. And real property is going to be the land and everything attached to the land. Okay. Now, obviously, land has no wear and tear. It doesn't have wear and tear. I mean, if you're mining it, then that's depletion, but that's not depreciation. That's a different concept. So land cannot be depreciated. So those things where there's no wear and tear, you can't depreciate. What we're talking about with respect to real property are usually buildings. Okay. So first, let's talk about personal property. So generally speaking, unless an election is made, so you have to elect to use straight line method. And as I mentioned early on, you usually don't want to elect straight line because double declining balance and makers, 150% declining balance, you get to depreciate more earlier, which is better because of time value of money, right? The whole idea there being that you want to get $1 back today instead of $1 back in the future, because $1 today is worth more than $1 in the future. All right. So generally speaking, with respect to personal property, you apply double declining balance under makers. Under makers. Makers basically, makers means modified and accelerated cost recovery system. So the general idea is that it's more than straight line, really. But I will tell you that even though their title is that, if you have a certain life, it actually can be straight line under makers. So if you have a certain period of time, just so you know. So under this method, a taxpayer each year deducts a portion of the assets adjusted basis equal to twice the percentage that would apply to the original cost if the straight line method were used. And the idea is that the basis will be reducing every year that you go down, so you're multiplying those percentages as you're going down, if you will. Okay? Just like we have in financial accounting. So that's what the percentages, which are actually tables, that's how they're computed. That's where these percentages come from. And you can get the IRS tables. It'll be ridiculous for any instructor or any professor to hold you to memorize those tables because it's really long, lots of stuff. So an example is that if a taxpayer is using double declining balance method, and there's a 10-year recovery period asset, well, under straight line, right, 10 years, that would be 10% per year. But under double declining balance, it'd be 20% because 10% times 2 is 20%. So that would be 20% each year, but again, you have to adjust each year. The IRS, again, provides tables that kind of take into account, with respect to the years, so you actually get to multiply the basis after steps 1 and 2, the section 179 and the bonus depreciation. You can multiply by the respective percentages calculated by the IRS. And those, are mathematical calculations, just so you know. Now, sometimes, with respect to makers, double declining balance switches over to straight line because if we don't have if we don't do this, then the percentages don't equal out to 100%, if you will. That's the idea. Okay, that's really what it is. Again, there's tables that the IRS provides with respect to these percentages to do this type of calculation. So again, to summarize, with respect to the depreciation method for personal property, unless you elect straight line, which almost nobody elects, okay? The reason you would elect basically is for where you think that maybe there's going to be changes in your company, maybe take advantage of certain things, different tax brackets, as well as possibility for legislation changing to higher rates maybe in the future. Because straight line, you get more later on. Double declining balance, you get more early on. That's the idea. But holding everything aside, holding everything constant with respect to rates, you want to do the modified accelerated cost recovery, which is what you can do under personal property, because time value of money. Real property only is straight line. So real property, you're only allowed straight line. So next concept is recovery period. Now, recovery period, we have to distinguish. Again, everything is basically distinguishing personal property from real property. So personal property, we consider, for everything we consider what's called a class life. That's what it's called under the code. In the Internal Revenue Service, they promulgate Rev Procs and various items, various notices that deal with class life, that tell you how many years you're going to depreciate over. So with respect to personal property, there's various class lives, and again, this is with the modified accelerated cost recovery system, but some of the most common are 3, 5, and 7. Now, if you are a 3-year class life, you actually depreciate over 4 years. And I'll explain this under the convention later on. If you are a 5-year class life, you actually depreciate over 6 years. And if you're a 7-year class life, you actually depreciate over 8 years. Now, there's also 9. It's usually odd numbers, but these are the most common, 3, 5, and 7. Most of the business assets out there are 3, 5, and 7. 5 and 7 especially. All right? Now, you don't need to, having to memorize every, whether, railroad spikes into the ground or railroad tracks, whether that is what year that is, memorizing stuff like that can get very, very, very nuanced. And for any instructor or professor to hold you to, test you on that, that would be ridiculous unless it's open book. That's beyond the scope of this discussion, but just keep in mind that class life is what is promulgated, and it's actually, there's hundreds, if not thousands of pages that the Internal Revenue Service publishes on this stuff that designates what kind of recovery period or class life with respect to certain assets. Now, real property is a lot more straightforward, and there's 2 recovery periods. If it's residential real property, so we're talking about buildings here, it's always 27.5. And remember, real property is going to be straight line under the method, right? So it's going to be straight line. So residential real property, 27.5 years. Non-residential real property, which is everything other than residential, right? So factories, office buildings, those kind of things. You're talking about 39 years. So some examples of residential real property, apartment buildings, right? Whether it's investment or business. If you own a duplex and you're renting that out, those are all residential where people are living. Okay, and it's an investment or a business. All right. So the last topic with respect to the depreciation mechanics, which this one tends to be the most difficult for students and practitioners and anyone that's learning about this for the first time, is the convention. So we talked about the method, right? Break it up, straight line versus for real property versus makers, double declining balance, accelerated for personal property. We talked about the recovery period for personal property. You have to look at the class life. right? And again, if it's a 3-year property, it's actually depreciated over 4 years. If it's a 5-year property, it's actually depreciated over 6 years, 7-year property over 8 years. And I'll explain why in a moment. And then for residential real property, it's 27.5. And for non-residential, it's 39 years. All right. How we came up with those numbers? Economics. All right. Again, that's what Congress says. That's what has been promulgated. We go by that. That's the idea. All right. And again, keep in the back of your mind this theme that time value money. We want to be able to depreciate and amortize as fast as possible if we can. So obviously, personal property is a lot better to depreciate because it's going to be a lot quicker, and you get those benefits with respect to time value of money. So convention deals with when exactly are we placing in service? When do we place in service property? When is it considered placed in service with respect to when we depreciate? Placed in service. Because when it's placed in service under the law, that's when we can start depreciating. Now the rules again are broken up into personal versus real. Again, you have to keep that in mind. So if you forgot about personal property and the definition of personal and real property from a legal standpoint, you need to know that. Real, land, everything attached to land, personal property, everything else. And again, we're talking about depreciation, so we're talking about tangible property, not intangible. That's the next topic, amortization. So for personal property, there's 2 possible conventions that you need to worry about. The first is the general rule, and it's the half-year convention. The half-year convention. The half-year convention says that regardless when you place in service, the asset will be placed in service at the midpoint of the taxable year. So in my examples, I always use calendar year. So halfway through a calendar year is on July 1st. So I have an example here where the taxpayer is a business and it's a calendar year business and it's halfway through the year. So you basically look at the year and you break it in half, depending on when it starts, right? If it's January 1st to 12/31, December 31st, then July 1st is halfway through the year. But that can also change, right? If it's February 1st and the year ends next year on January 31st, then halfway through the year will be August 1st, right? And so on, right? It's halfway through the year is the idea. Now, there's a special rule to this, a special exception to this, that says that if the taxpayer acquires more than, it's not equal to, it's more than 40% of his or her, or its, if it's a corporation, tangible personal property. That's all we're looking at. Tangible personal property, not real property. This is very important. It seems that practitioners, students, they always mess this up. It has to be more than 40% of tangible personal property. If more than 40% of tangible personal property is placed in service by the taxpayer during the last 3 months of the year. So if it's a calendar year, the last 3 months, right? If we have a year, right, you can break it into quarters. So we're talking about the last 3 months. So this is October 1st to December 31st. So we're talking about October, November, December, the last 3 months, right? If more than 40%, so if greater than 40% of the assets placed in service, if they're placed in service during the last quarter of the taxable year, then a special mid-quarter convention applies to all tangible personal property, not just that last quarter, all tangible personal property, all. So you have to look at the middle of each quarter that's placed in service with respect to those assets. So if you had some property placed in service in the first quarter, well, halfway through the first quarter is February 15th. So those assets that are in quarter 1, right? This is quarter 1, this is quarter 2, quarter 3, and we have quarter 4, right? So any asset you place in service, if this rule applies, right? Any asset that's placed in service is going to be that was purchased and placed in service economically by the business in quarter 1 is going to be considered placed in service for tax purposes in quarter 1 under this rule, but that will be deemed as February 15th. And that means that you only get, for that year, you're only going to get a 10.5 month amount of depreciation. Okay. Now you get it later on, you get it pushed back, that you don't get that first month, you don't get it from the beginning of the year, the idea. Okay. So if you bought it on January 1st and the mid-quarter convention applies and you're a calendar year business, it actually be deemed to be placed in service on February 15th. That's the idea. And I have an example of that, how we compute that. Take a look at this example. So I have two assets that were purchased by the company. February 1st, purchased an asset for $20,000, and then November 1st, $30,000. And this is the calendar year. So this is January 1st, December 31st. So we add them together, right? 20,000 plus 30,000 is 50,000. Since 3/5 or 30 over 50, right, which is 3/5, which is 60%, since greater than 40% is in the last quarter, the last 3 months, guess what? We don't apply the half-year convention. We apply the mid-quarter convention, right? So the February item that was purchased on February 1st is deemed placed in service in quarter 1, which is February 15th, halfway through, and the item purchased on November 1st, which is quarter 4, is deemed placed in service on November 15th. Now, real property is much more simple. Just like in the past, real property tends to be the most simple, so I would definitely look out for real property on whatever exam you're taking. If you're taking an exam or CPA exam, or if you're in a law class, that kind of stuff, because professors, instructors love to test this because the rules for real property are way more straightforward with respect to testing these concepts. So for the real property, mid-month convention always applies, regardless. So mid-month means, hey, let's say we have a calendar year business, right? Calendar year business. And regardless, it doesn't even have to be calendar year business. Whatever month you have. So let's say that we have a business, and this is the month of March. Let's just say that this is the month of March. This is March 1st through March 31st. So 3/1 to 3/31. Regardless, if you purchase real property in your business or investment activity, and you purchase real property during this period of time, you're going to be deemed to place in service for tax purposes, if it's real property, March 15th. Regardless, and that's what my example shows. Regardless, it's going to be March 15th. That's the idea, is that with respect to real property, it's always considered halfway through that month. It's always halfway through that month, just so you know. Okay? So that really concludes depreciation. One thing I want to talk about, one last concept I want to mention before we go on to amortization, is the concept of allowed versus allowable. Allowed versus allowable with respect to depreciation. Allowed versus allowable. So the term allowed, I know some of you are thinking, like, whoa, like, doesn't this kind of, like, these two terms seem like very similar? And they are with respect to the Internal Revenue Code, but there's a fine line, and it's very important to understand. So in the Internal Revenue Code, there's a provision that deals with taking cost recoveries and reducing basis down. So as I mentioned, we reduce the basis of property for any depreciation taken, right? We reduce basis by depreciation or amortization, right? Or any section 179. We'll talk about 197 when we talk about amortization in a moment. Bonus depreciation, those things, if you take them, they reduce your basis. That's important to understand. Now, allowed is what's taken on the tax return. Allowable is what's calculated for tax purposes. There we go. All right. So you might calculate, let's say, $10,000 of depreciation, but you make a mistake, let's say, and you only take $9,000 on your tax return with respect to an asset? Well, the rule is you always take the greater of these two numbers, and that reduces your basis. Take the greater of the two numbers, and that number will reduce the basis. So the $10,000, even though you didn't get the benefit on your tax return, actually reduces the basis because that's what you should have done under the law. But what if you did the opposite? What if you did $11,000 on the tax return, but you only were allowed to take $10,000? So basically this goes to errors. Well, under law, you take the greater. See, I even caught myself there, right? I started to circle that because I was looking at the one. We take the greater of the two, right? 11,000 is greater. So here, the basis will be reduced by $11,000. So this is something important to understand, is that when it comes to depreciation, amortization, anything where you have to calculate, depletion, you have to calculate an amount that's allowable under the law. What's allowed, what you actually put on your tax return, if that is conflicting, then with respect to reducing basis, because basis, remember, is that storehouse of unrecovered capital, and the idea is you can't get double tax benefit. If you get to reduce it for depreciation, amortization, depletion, you can't take it again later on when you sell it. You have to reduce by the greater of the two numbers, even if the greater number is the allowable under law, but you didn't take it on your tax return. All right. So the last topic to discuss is amortization. So amortization is going to be a lot more simple for you to understand after you learn about depreciation, because all that stuff with the recovery method, with the recovery method, with the recovery period, and with respect to the convention is going to be very straightforward. Now, amortization only applies to intangible assets. And recall that intangible assets, well, you can't have intangible real property, so it's always personal property. All right? Intangible assets, personal property. Okay? Intangible, which deals with personal property, because personal property is everything other than real property. So this checklist will help you determine whether you can actually amortize a specific intangible asset. So first is that we have to have a Section 197 intangible. We have to have a Section 197 intangible. So Section 197 D1 specifies many types of intangibles that meet this category. And these, I have some examples, and because, yes, these are listed in Section 197 D, but it actually says that there can be others that are similar to these that might not be out there. There's so many different types of intangibles out there, and there's more and more, as we go in time, right? Technology, this is the whole idea here. Section 197E specifies types of intangibles that do not meet the category. So this is over here, examples that do not meet the category. And again, same idea. This is just some of those, right? There can be similar ones out there as well. So here are some examples of qualifying intangibles. Patents, copyrights, formulas, processes, which are all kind of along the same lines. Designs, patterns, all along the same lines. Then we have franchises, trademarks, trade names, workforce in place. So that's looking at your actual employee force. Business books and records. Customer-based intangibles. So this is stuff like market share, along those lines. Supplier-based intangibles. So if you have a some type of relationship with your supplier. So the customer base deals with relationships and market share and stuff like that. Suppliers, if you have relationships with suppliers. Licenses, permits, or other rights, or other right, I should say, granted by a governmental unit or agency. Covenants not to compete are part of the intangibles that can be amortized, not depreciated. Depreciation's for, again, tangible property. As long as they are entered into connection with the acquisition of a trade or business or interest in a trade or business. That's the key. So they have to be entered into the connection with buying a business, basically, or acquiring it. Goodwill and going concern are the catch-all. Those are really hard to generally define, but they are amortizable if with respect to those items. Okay? Now, examples of non-qualified are interest in business entities. So if you own a partnership interest, you own stock. Interest in estates or trusts, same idea. If you have an interest in those, that's not amortizable. Interest in financial contracts, so this is like futures. Anything along the same lines as those. Hedge commodities, those kind of things. Interest in land. Okay, land cannot be depreciated, nor can an interest in land be amortized. Interest under existing debt instruments. So if you have some type of contract with respect to a debt instrument, then you can't amortize that. Interest under existing leases of tangible property. I have tangible. That should be tangible tangibles, so tangible property. Professional sports franchises. So those people out there, you might be wondering, okay, well, somebody purchases a professional sports franchise. I noticed that franchises in general can be amortized, but professional sports franchises cannot. Right? We're talking about the franchise fee, generally speaking, versus the professional franchise fee. It cannot. Okay, it has to be capitalized over time. Interest in film, sound recording, videotapes, books, or other similars not acquired as part of an acquisition of trade or business. So basically what we're talking about here is that you've self-created these. So anytime you see not acquired as part of an acquisition of trade or business, we're talking about self-created, which you're going to see the next requirement takes those out. Interest in patents or copyrights that are not acquired as part of acquisition of trade or business. So this is interest in. These are interests, by the way. These aren't actually the items. If you have the film, sound recordings, videos, you might be able to amortize, but it's the interest in it. So these are the interest in. That's key. Software, not acquired as part of acquisition of trade or business. Readily available computer software, although under Section 167 F5, there's some special rules. I'm not going to get into that. We call it shrink wrap, shrink wrap software, like it's right off the shelf software. It's already in the shrink wrap. So if you go to Office Depot, that's an exception with respect to that. I'm not going to go into that. Rights with respect to tangible property, services, or items in certain government contracts. So there's special rules when the government contract is less than 15 years and stuff like that. Just know it generally with respect to that item. So if you do have a qualifying intangible asset, continue. If not, then you can't get Section 197 amortization. However, you might be able to still get depreciation under Section 167F or Treasury Reg 1.167-3, which is beyond the scope. If you don't get any of those, 167F or 167 Reg 1.167-3, then you have to wait until you sell the item or you exchange it or whatnot. Now, one thing I want to note is that depreciation, it says depreciation under the code, but there's actually a provision in Section 197 that says that throughout the Internal Revenue Code, if it says anything about, in general, with respect to depreciation, they actually imply that implied to amortization as well. So later on, another topic, we're going to talk about Section 1245 recapture. That's a characterization issue. And within 1245, it talks about depreciation must be recaptured. But the way it's written is that, again, in Section 197, 197F7 to be specific, so that's 197F7 if you're interested in looking that up, it specifically says that if you have certain language throughout the rest of the Internal Revenue Code, all of Title 26, it actually is implied to mean amortization as well. Very interesting concept. And I'm assuming that in the depletion rules, which I haven't studied in too much detail because depletion is more about, when you live in like an area of mining and, this is coming from Florida, right? So we don't really have much depletion. But I'm assuming that there's a very similar rule with respect to depletion as well. So again, if you don't get those respective items, then you just have to wait until sale or other disposition to recover the basis. So the next question is, if you have one of these qualifying Section 197 intangibles, is it considered self-created? If yes, if the intangible is considered self-created, then you cannot amortize it under Section 197 unless it's acquired with respect to the acquisition of an acquisition transaction, which is one that constitutes acquiring a trade or business. Okay? Constituting a trade or business. All right? Now, you might be able to get some other type of research and expenditure with respect to self-creating a patent or some other way you can take these faster deductions with respect to these intangibles, just so you know. All right? You can take these various items. But again, you're not allowed to do it under Section 197 amortization of intangibles. So self-created in connection with an asset acquisition. If the intangible is self-created in connection with a intangible asset acquisition, then we continue. All right. So if it is this exception, this is the exception I mentioned above, then we continue along with the checklist. So we're going to continue. All right. If it is considered a self-created intangible, right, unless it can be depreciated under Section 167 or 1.167-3 or some other general provision. Then you can't get a cost recovery until the sale or other disposition. So again, an example where you might be able to deduct a self-created intangible is with patents with respect to research and experimentation expenses. All right, we call it R&D, research and development expenses with respect to accounting, but it's actually R&E with respect to tax. If it's not self-created, then we continue along. Okay, so you can either continue if it's the exception, which is the acquiring as part of a business, or if it's not considered self-created. All right. Finally, is the Section 197 intangible held for business or investment activity? If it's personal, you can't amortize, and you're not going to be able to get any cost recovery. I can promise you that until, again, you sell it. And was it acquired after August 10th, 1993? The reason that this rule came into play is because before August 10th, 1993, it was very limited types of assets, and it was very there was a lot of facts and circumstances to determine whether your asset qualified in a specific category. And then Congress came in and they just made it a lot more bright line, kind of, if you will. I mean, there's still some types of things. There's still some types of, subjectivity out there, but it's a lot more straightforward now after August 10th, 1993. So if it's acquired before, you don't get Section 197. But if it's acquired after, then yes. If yes to both, then the asset is amortizable. Okay? And I just have a summary here, which is basically up here discussed, but the summary is down here. The amortization, it will be straight line. It will be over 180 months, which is 15 years, but we can say 180 months. And the convention is the full month convention. So let me explain by the example. So let's say you acquired an amortizable intangible asset, meets all these requirements on May 7th. Well, under the full month convention, it's considered to be placed in service on May 1st. If you acquired it on May 31st, it's still May 1st. So regardless, when you acquire, this is the month of May, right? 5/1, 5/31. Regardless, when you acquire the asset, it will still always be May 1st under the full month convention. And we do it over 180 months, which is 15 years. Now, if it fails either the business or investment activity, so it's personal, or it fails being acquired before on August 10th or before of 1993, then unfortunately you cannot take Section 197 amortization. And again, the rule applies that you might be able to do it under Section 167F or Tres Reg 1.167-3. This concludes our discussion of amortization as well as depreciation.